Good morning, everyone, and welcome to the first session of the MF. As Susan mentioned, this is a very interesting session at the intersection of macroeconomics and finance, and we have three papers. Just to give you a quick prelude to what the papers are about, the first paper is basically looking at the monetary system as an infrastructure. It's a very interesting perspective, as opposed to, and therefore banking regulation is viewed as an infrastructure regulation. So it's very different from the role of banks as financial intermediaries, where they're driven by profit and loss considerations. So we definitely look forward to an interesting discussion on this paper. The second one, while remaining on the theme of money, talks about foreign exchange reserves on the balance sheet of central banks and how central banks can use an asset liability framework to do portfolio optimization while they're holding reserves. And that nicely segues into the last paper of the session, which talks about early warning indicators for currency crisis in India, one of the indicators being foreign exchange reserves of the central bank. So without further ado, and to take advantage of the time benefit that we have, I would request the first presenter, Morgan, to start his talk. Each presenter has 15 minutes, and I'll inform you about how much time you're left with using sheets of paper. Then the discussant will have 10 minutes each, and we will open up the floor to questions for 5 minutes. Given the tight schedule, we may not have enough time for the speaker to respond to all the questions and comments, but then we'll be here for 3 days, so we have enough opportunity to discuss over lunch and tea breaks. So with that, I hand over the podium to Morgan. Thank you.
Well, thank you very much. I'm delighted to be here in this beautiful place, which I've never been to before, and with this distinguished audience. So this paper is somewhat conceptual. I don't know if that's a good thing or a bad thing, especially to start the conference with a somewhat conceptual paper, but here we are. So this paper builds off of a book that I published last year by University of Chicago Press, titled The Money Problem. I encourage you all to take a look at it if you get an opportunity. So the book, I'm going to say a word about the book because this will help to situate the paper a little better. So the book, the central argument of the book is that financial instability is mostly a problem of private sector money creation. And this is an old-fashioned view. This was Irving Fisher's view, this was Henry Simon's view, this was Milton Friedman's view, but it pretty clearly is not the view of most experts in the field today, and it most definitely is not the view underlying the financial stability reforms of recent years in the United States and abroad. So I'm arguing in the book for doing financial stability regulation rather differently from how we've been doing it. And lest you think this is, that I'm proposing something radical here, in fact the opposite is true. My argument is conservative. I don't mean that in a political sense, I mean that in a descriptive sense. I argue in the book that old-fashioned US bank regulation embodies a coherent economic logic, and that the primary task of financial stability reform is or ought to be to follow through on that logic. So we've been preoccupied, in my view, with items that should be low priority items, and we have neglected the topic that should have been and should still be the central area of focus for financial stability regulation, which is private sector money creation. Just as an aside, this isn't the outer reaches of modern finance. It's the exact opposite. This is the most primitive part of the financial system. This is zero coupon or demandable IOUs. It doesn't get any simpler than that. And this is where the real action is, in my view, from a stability standpoint. So this is a view I think is associated now with Gary Gorton and some others in the Economics Academy. And in the book, one of my key arguments is that this is a sensitive activity, money creation. It's sensitive from a stability standpoint as well as from a monetary control standpoint and from a seniorage standpoint. and that historically the way we've dealt with it, and really the only sensible way of dealing with this, is through entry restriction into money creation. This is the first step of banking law, both logically and historically. The whole history of Anglo-American banking law can be written in terms of entry restriction. Not entry restriction into lending or intermediation. Instead, we're talking about specifying the types of liabilities that chartered banks are permitted to issue that others are not. So in an earlier era, this was about banknotes in the 19th century, at least in the US and England. Later, it was about deposits. And necessarily, when we talk about entry restriction, we're talking about a generalized prohibition. This is prohibiting everyone who doesn't have a banking charter from issuing a certain type of liability, which means that the banking charter confers an exemption from the prohibition. That's the purpose of a banking charter, is to confer an exemption from a generalized prohibition. So famously, in the US at least, we had entry restriction into banknote creation with the beginnings of federal banking legislation. The National Bank Act of 1864 prohibited anyone other than a national bank from issuing banknotes. The point of this was to restrict entry into banknote issuance, which was perceived as a sensitive activity, and it was a sensitive activity. Later, and in modern U.S. law, it relates to deposits. So 12 U.S.C. Section 378A2, the single most important provision in all of banking law, which remarkably doesn't get mentioned in most of the U.S. Legal treatises on banking. It says, thou shalt not, it says, this is not an exact quote, thou shalt not issue deposit liabilities without a banking charter. A funny thing is that raises the question, well, what exactly is a deposit? And here we face a problem because yes, we say you must have a banking charter to issue deposit liabilities, but when you look at the definition of deposit, it's a liability of a bank. So you're in a perfect legal circle. And this is, in my view, the original sin of banking law. The failure to specify on a functional basis what constitutes a monetary instrument is the original sin of banking law and the primary source of our current regulatory troubles. Most specialists think these issues are really too basic for them to think too hard about. I'm speaking of U.S. specialists. I don't know how it is in India. They want to move on to other sexier issues, macroprudential supervision, stress tests, systemic designations, resolution, what have you. And I'm contending that there's a really basic flaw deep in the operating system of our monetary framework. And what we end up doing is developing these elaborate, hyper-technical regulatory patches to deal with this problem as opposed to dealing with it in the internal deep code, which is at its core a generalized prohibition. Okay, so now I've set the stage for my paper. Don't worry, I can move through the paper now that I've done that in relatively brief fashion. So this piece stems from a desire to situate this understanding of banking within a somewhat broader regulatory context. And when we think about entry restriction in U.S. law, the first thing that we ought to think about is what might be called traditional economic regulation or infrastructure regulation or the regulation of network industries or public utilities and common carriers. These are all essentially synonyms. And the heyday of this model of regulation in the U.S. was from the New Deal, from the mid-30s, say, until around 1980, when there was a substantial move in the U.S. to deregulate at least the spatially expansive transportation, energy, and telecommunication sectors. I happen to think this was a really big mistake, but I'm not going to get into that argument here. When I say a mistake, the deregulation was a mistake. I think that this model of regulation had a lot of virtues and was unfairly maligned. But what the interesting thing from the standpoint of thinking about banking is that the modern literature on infrastructure regulation has at its core a notion of franchise bidding or procurement as being the analytical framework within which we understand this. And this goes back to Dempsey in the 60s, but it goes through Tirole and the rest of the economic literature, and this is also very much at the center of the legal literature on these industries. We think of it in terms of procurement, contracting, or outsourcing. And if you look back then if you take this model in hand and look back at the National Bank Act, the beginnings of U.S. federal banking law, 1864, there's a one-sentence statement of the purpose of that law at the beginning of it. And what does it say? It doesn't say an act to regulate financial intermediation or to regulate lending. What it says is it's an act to create a national currency. That's the purpose of the National Bank Act, an act to create a national currency. It is explicitly set up, and the whole structure of the law is set up as an outsourcing contract. We're outsourcing the issuance and circulation of the money supply to chartered banks. And we are prohibiting anyone else from issuing money other than these chartered banks. Money in the form then of banknotes. Of course, famously, in the 19th century, it wasn't well understood that deposits were essentially uncertificated banknotes. And so we didn't take account of deposits in our monetary framework or in our entry restriction. And of course, the great irony here is in modern understandings, the deposit, the checkable deposit, the transaction account is the quintessential monetary instrument. Read any macro or finance textbook, and bank money creation is now depicted as deposit creation as opposed to banknote creation. So this was just an error. This was just in retrospect now, a very basic conceptual error of thinking that paper really mattered. And that account money, as I'll call it, account money meaning money that's reflected in a ledger as opposed to being in the form of bearable currency, thinking that that wasn't really money. We would never make this mistake today, right? Well, consider the rise of shadow banking, which is the creation of deposit substitutes, and ask yourself whether we're not susceptible to the same types of conceptual errors. So this paper's asking, what if we take this understanding seriously? This kind of monetary outsourcing understanding of what a bank charter is, and take the notion of entry restriction seriously. This leads you directly to thinking about an institutional baseline of direct government provisioning, right? You don't think of banking as something out there that you're then extending regulation to. You think of this as a public function that you're outsourcing through a banking charter. And I want us to just think for a second about what this means. What if everyone, let's think of the insourced or direct government provisioning structure just as a conceptual model, right? Think of that as the institutional baseline that we're thinking of. What does this mean for, so imagine everyone holds their account money at the central bank, right? Just as everyone who holds physical, well, India is a special place to talk about this, but let's imagine we're in the U.S. right now. Everyone holds their physical currency, their tangible currency, which is a liability of the central bank. Imagine everyone's account money was also an entry in the central bank's ledger, right? So we don't have any private sector money creation. This is related to what Milton Friedman and others supported as 100% reserve banking, right? All money creation is by the central bank, and Henry Simons and others have advocated this view, actually as a policy proposal. I'm not advocating this as a policy proposal. I'm just asking that we think about this as a way of thinking about what banking regulation might look like. What would interest on deposits, interest on account money look like in this world where everyone holds their account at the central bank? Would it be determined by market forces, quote unquote? Well, that's almost a nonsensical thing to say. Right? The central bank's liabilities aren't determined, the interest paid on central bank liabilities aren't determined by market forces, quote unquote. They're determined as an administrative matter as part of the conduct of monetary policy. And my argument is, so it's nonsensical to speak of the rate paid on money as, in this in-source world, as determined by market forces. Well, my argument, this is where you're going to start throwing things at me maybe, is that nothing changes. Nothing about this analysis changes when we shift to outsourcing. The monetary authority can, and in the past has in the US, and I believe India also, and many other jurisdictions, exerted administrative control over the rates paid on account money in the forms of deposit liabilities. And here I'm cutting strongly against the grain of prevailing thought. Maybe that wasn't such a bad thing. Central bank administered rates, at least as practiced in the U.S., and they've only been practiced in the U.S. since 2008. Other jurisdictions have a lot longer history with administered rates. But it's been problematic. It's been problematic from an efficacy standpoint. The Fed funds rate has not cooperated in quite the way that Bernanke and others expected it would. And even when we got the federal funds rate within a bound that we thought was good, other money market rates were not cooperating. We had to form additional facilities, the reverse repo facility to the money market funds, to nudge institutional money market rates upward. So there's efficacy concerns, and there's also distributional concerns, I believe. We're not getting the kind of pass-through that we expected on deposit rates and on bank deposit rates. And it just seems to me that if we're going to conduct monetary policy by cutting checks to banks, at least in the first instance, we ought to be considering whether that might not be a good thing for banks, as opposed to everyone else. They have privileged access to this type of account money, and no one else does. And we should think about the distributional and equity aspects of such a system. So we could think about doing it differently. We could think about directly administering bank deposit rates, as we did in the past. And this raises concerns about bank profits, of course, for holding, in the past we held bank deposit rates below what a quote-unquote market clearing rate was. That market clearing rate only existed because we had not sufficiently restricted entry into the creation of money, right? This all arose as a consequence of money market mutual funds and other institutions. But of course, it doesn't have to be that way either. So we can imagine a system in which if banks were earning excess profits from holding deposit interest rates at a level determined by monetary policy, that the difference between that and a fair rate of funding would accrue to the government as seigniorage. We could imagine that being a seigniorage fee stream that flows to fiscal revenue. Just as if we were insourcing, and if the central bank were the only issuer of account money, then the difference between its earnings and the rate paid on account money would flow to the government as seigniorage. So again, I'm arguing that once we outsource, we don't have to change the way we think about all this. We can think about it through the same framework. And this is my final point. I think I only have about a minute left. We already have a fee stream, at least in the U.S. I'm not sure how it works in India. We already have a fee stream from the banking system to the government. It's called deposit insurance premia. They're risk-based in the United States, so we're already doing the kind of analysis that we need to do to charge banks, at least in principle, a fair rate of funding. So increasing this to a level or setting this at a level that reaccrues privately captured seigniorage would not be, is a relatively trivial problem once you've solved the problem of charging a fair rate of capital. I'm out of time. I have a separate section in this paper which is about financial inclusion. In the U.S., we have a rather disgraceful structure to our monetary system where banks which run the mainstream payment system are able to exclude based on profit and loss considerations a surprisingly large component of our population from the mainstream payment system. If we think in terms of an outsourcing perspective there too, all sorts of government services are provided to some users below marginal cost, and there's no reason that it wouldn't be the same thing for account money rates under insourcing, and I'm suggesting yet again we don't have to change the way we think about that when we move to outsourcing. And I will stop there. Thank you.
Harsh, 10 minutes.
Hello, I'm audible, right? Yeah. No, it's okay. I do it from here? Yeah, okay. So thank you, Rajeshwari. I really found this paper interesting for primarily two reasons. One is when I see somebody from US coming in talking about things like administered rate and mandated access, I just feel very encouraged that if not in politics and academia, at least liberal thinking prevails still and thrives. But second, more important reason is Rajeshwari and I, we've been spending a lot of time last few months on looking at transmission in India. And one of the results we see, early results, is the same, which is that the transmission on the deposit side is very poor. And we've been spending a lot of time figuring out why that is so. And your paper throws some light on that issue. And I was surprised to see that it's so in the US as well. I think the whole idea of looking at money stroke bank as utilities is a very interesting one. And in India, especially when we emerged from the socialist era, if you went back India 20 years, we were actually in a situation that you envisaged, which is pretty much all rates were administered, both on the liability side, but equally importantly on the asset side of the bank balance sheets. We were in a completely rate administered system. And because our monetary policy in those days wasn't really monetary policy, we can't really assess the effectiveness, efficacy of monetary policy. But it did create implication that we need to take into account here, and that's the reason I brought it up. And which is this: you talk about two perspectives in banking, the monetary perspective and the financial intermediation. They sit quite sort of in uneasy tension with each other. I think the moment you take the money and bank as infrastructure view, it to my mind conflicts with bank as financial intermediaries. And the reason for that is the moment you administer rates, it has second order implications on mispricing of risk, which happens on the asset side of the banks. And as a result, the financial intermediation role of the bank comes in the way of its role as monetary institution. And so, for example, if we went back to India, what we saw as a result of administered rates is large-scale system-wide mispricing of risk. And so that to me is a very important issue to keep in mind, that you cannot run away from the intermediation role of banks by focusing just entirely on its role as monetary institutions. That's one. Secondly, if you take one step back, the financial intermediation role is really an information asymmetry role. The moment you administer rates, you take away the informational value of rates. I don't know if you agree with that, but that to me is the reason why that administered rates would actually conflict with the financial intermediation role. The second point I have is that also relates to then you give two reasons as to why the monetary role of institution became less dominant in the 20th century. One was the difference between bank accounts and banknotes. The other one was the rise of finance as a discipline. There's probably a third one, which is the rise and the overwhelming presence of central banks. Because the whole thinking was that once you give them the monopoly of money creation, they would regulate the private money creation in a manner that's aligned to their own policy. And we're clearly seeing that that's probably not working. But to me, that also has an implication of understanding how the central bank is constructed. There's a growing orthodoxy I see which says that monetary role and the financial regulator role has to be separated. UK has done that, for example. The kind of thinking in this paper suggests to me that there is merit in keeping the two roles together. So we have what we in India we call full service central bank, which is both the monetary function as well as regulatory function. Because that's the way you can balance these two kind of perspectives in a more, let's say, efficient way, the intermediation role and the monetary role. So the last point I would make is that potentially the third perspective, so the two perspectives that you started with, which is banks as financial intermediaries, banks as monetary institutions, there is probably a third perspective I feel merits some attention. And I struggled to come up with a name for that, but the name could be banks as marketplaces. If you abstract away from regulation, banks are nothing but market makers in market for funds. They are constantly giving a two-way quote. This is the role an exchange performs. So if you look at how exchanges are regulated and how participants in exchanges are regulated, I think that might throw some light on what's the right balance between intermediation role and the monetary role. I'll stop there.
Would you want to respond, Morgan, before we open up the floor?
Yes, thank you for those comments. That was wonderful. So administering rates leading to mispricing of risk. So I think that is a concern. I think also we could think of deposit insurance premium or deposit insurance itself as leading to a mispricing of risk, and we're already doing that. So once we've applied deposit insurance and we have a nominal cap on deposit insurance, but when the rubber meets the road, the cap goes away. So I think implicitly we have, in fact, an implicit public backstop of the entire institutional money market also, not just deposits. That's what we learned in the recent crisis. And so what type of mispricing of risk does that entail? I think quite significant. And so in principle, my view is that we should do what traditional U.S. bank regulation has done, which is try to confine the left side of the bank's balance sheet, the commercial banking sector, to relatively safe relatively safe credit assets, consistent with the accommodation of the desired money supply, right? You can't set that limit. This is what I think where the narrow banking folks go wrong, is you can't set that constraint in the abstract. It's a function of your desired money supply. But once you've confined that, then and if you're going to apply deposit insurance, then you are charging a premium that is an administered judgment about the risk of the portfolio. And in my view, the additional mispricing associated with administered rates becomes quite modest, because under the framework that I kind of lay out in the paper, if there is a disjoint between a fair cost of financing for a bank as judged administratively and the actual cost of financing paid on administered rates, that difference, that wedge, should flow to the government as seigniorage, right? That should be a fee that flows to the fiscal authority. And of course you can't do it perfectly. You'll never do it perfectly, but that's true of every area of economic and financial regulation in which we have to make some sorts of judgments. It was true of traditional infrastructure regulation and telecom and transportation and the other areas I mentioned. I do think you're right that risk will be mispriced sort of no matter what against some neutral benchmark of risk, objective benchmark of risk, but we've got that problem anyway, as long as we're doing explicit or implicit backstops. And let me, were we going to have other questions? I'm not sure what the protocol was, or if I should stop there.
Questions from the floor.
Okay.
One quick comment.
Sure, go ahead.
So you're absolutely right about deposit insurance, but we can probably do a separate send. It has problem. The price is ex ante set and risk is taken ex post, and therefore it's never risk-based pricing, because in fact, there is a literature which suggests that if you set risk premium ex ante, then it incents people to take higher risk because of return on equity and so on. So I think that problem will persist.
There's no doubt that just as a rejoinder. So, the empirical evidence in the U.S. is that when we didn't adopt risk-based pricing until 1991, but stocks of riskier banks went down and stocks of safer banks went up on a relative basis. I mean, it did show at least some market perception that we would be able to, in some rough justice kind of way, apply higher premiums to riskier banks. I think that has mostly been the experience under FDIC-based pricing, although I'm the first to admit that the FDIC has not done this perfectly.
Thanks, Morgan. We do have time for questions from the floor, if anyone has any question.
What do you think about this proposal? Like, I know you have read this book, Mervyn King, The Alchemy of Money. What do you think about that proposal? I don't know, are you aware about it?
Yeah. So King's written a really interesting book. I think my institutional design that I lay out in my book has a lot of advantages, but there are certain similarities to it. I mean, so for those who aren't familiar with King's proposal, he argues that essentially anyone who wants to issue into the institutional money markets or the retail money markets, anyone who wants to issue deposits or money, quote unquote, we can decide how we define what money is, should be required to post with the central bank collateral to essentially provide liquidity insurance, a kind of ex-ante guarantee, and instead of doing fees, which is my framework that's derived from deposit insurance experience, he thinks that haircuts on various types of collateral serve a similar function, and so I agree that his approach does deal with the stability issues in the same way that I think we ought to be dealing with them. In other words, money should just be money and guaranteed. There shouldn't be credit risk associated with monetary assets. But he doesn't account for the monetary control and seigniorage issues that I think are also pretty prevalent in this area, and I think we need to think a little more capaciously about institutional structuring to get at a structure that deals with all of those issues. So I think that's my primary issue with King.
Any other question? Okay, so then I guess we move on to the next paper. Oh, sorry, there's a question. Yeah.
Thinking then he was able to present. And I think that your point about the distributional effects is really interesting. And so if we have a little time, I wonder if you could take a few minutes and say some more about that, the implications of allowing banks to charge whatever they want for their services, and how that seems to cut off large sectors of the population from banking services.
Yes.
Maybe that's not a fair statement of what you're
No,
talking
well,
about.
so it sort of brings two parts of the paper together that I might think of in separate buckets. But so when I talked about the distributional issues in part one, which was about monetary policy, I'm just talking about how sensible is it that we are conducting monetary policy by writing checks to banks? Is that a sensible way of structuring monetary arrangements? You know, it wasn't until 2008 in the U.S. that we did that at all. We had pure scarce reserves approach to monetary policy until late 2008 when we moved to administered rates. And I know much of the rest of the world got to administered rates before we did. But as my discussant pointed out, we're seeing real pass-through issues. And I think it raises basic questions about whether this works inures to the benefit of banks and to the detriment, therefore, of the public. I think that's a fair question to ask about administered rates frameworks. So that's what I was speaking about, distributional implications. And there's broader distributional implications, in my view, of the failure to restrict entry into money creation, because I do think that the yield differential of issuing monetary instruments can be thought of as a form of private capture of seigniorage. This is an argument that Jeremy Stein and others have made also. So I think that's another issue. I think what you were getting at, Margaret, and I'll wrap up, had to do with the second part of the paper as much as with the first part, which is about access to the mainstream payment system. And I know that India's been has had its own approaches, and other jurisdictions have had their own approaches to payment system access. And in the U.S., I think the way we're doing it is just not satisfactory. The lower end of the income and wealth spectrum is left with without access to account money in the form of deposit accounts, because they're priced out of the system by banks who do it on a marginal cost basis, right? They do it on a profit and loss calculation basis, and that leaves the less fortunate parts of our society without access to the mainstream payment system. They're operating either in the cash economy or with money orders or with prepaid cards that have real functionality issues and security issues. And it's a less convenient, less secure form of money, and often doesn't have deposit insurance also. So we leave the lower end of our income distribution without meaningful recourse to the mainstream account money system. And my argument in this paper is, why don't we think of this the way we think about the interstate highways? An open access infrastructural resource. And we could do that. We could do that. Yes, I'll stop there.
I was thinking the connection to what the experiment in India a year ago would really maybe draw some very interesting comments from that.
I'm sorry, I'll have to cut you off there. Sorry. Yeah. Okay. Oh, great. Thank you.